Ari Karen. Ari is a veteran compliance attorney. He is also a partner in Strategic Compliance Partners, which is part of the Brokers Are Better vendor network. Ari, please introduce yourself to the Brokers Are Better community.
Thanks, Anthony. Yes, my name is Ari Karen. I'm a CEO of Strategic Compliance Partners and also a partner at the Ari Karen law firm. And in addition to sort of having a compliance background, and I'm saying this because I have a feeling we're going to get into some of these issues today, my background actually before I did compliance was actually employment law. So a lot of the issues I'm sure that are going to come up because of coronavirus and what we're talking about today will sort of delve into my background there as well.
Absolutely. So brokers, if you could, please post your questions for Ari. Ari's a compliance expert, and today he's providing. What's the disclosure here? I know you're not providing specific legal advice, but you're answering compliance questions broadly.
Yeah, I would say compliance and employment questions. I can answer both of those. But obviously, we're not creating an attorney-client relationship here amongst all of us together. There's no privilege, any of those types of things. So other than that, we're good.
So let's get started with one question that has been coming up a little bit is, people are concerned about, as we go into potential state-by-state shutdowns, how does that impact, if an employer if a broker is not able to generate revenue, if they had to potentially, put their people on furlough or something like that. What position is a broker owner in if hypothetically they're limited in their income capabilities with their teams?
Okay, so there's a couple of considerations that they have to think about. In terms of, yes, they can furlough people, but I think before you even get there, step one is you say, okay, well, do we have, can I give unpaid leaves of absence, right? You could also call it a furlough. As long as you're not of a size that would implicate the WARN Act, and it's not going to be for a period of 6 months or more, you don't even have to worry about those areas of the law, which is called the WARN Act. So then you really get down to, can I let somebody go for this or put them on some type of furlough? And the answer is yes. Now, pay attention though, because as of 52 minutes ago when I checked this, the Senate was about to pass a bill for paid sick leave. Now, I don't know what that bill is. It hasn't even passed yet, and it could change between, an hour ago and now. But you have to pay attention to that, because if there is a requirement that you provide sick leave, and usually it's going to depend on employer size. Many of these have cutoffs on the size of employer it applies to, so you have to look at that. You might have to go through that sick leave period first. The other thing to remember is state law. This will be a big issue on state law. So for states, one of them comes to mind is New Jersey. I think New York City has a paid sick leave law. You would have to comply with those as well. Again, it depends on your size because they usually have employer size cutoffs. The other thing I would say, and I will be very clear about this, this is outside my expertise, but this is general law stuff, right? So you would need to talk to a lawyer who's got the expertise in this. But if you have leases, if you have other contractual commitments that would require ongoing payments, many of those clauses in contracts have something called a force majeure clause. What that means, it's Latin, but it basically means that, if the end of the world happens, right, you can get out of this because it's something we could never ascertain occurring. I don't think this is the end of the world, but pretty close if you think about it from a legal standpoint, right? I mean, and I'm not trying to go too far here, but the point is, if you're in Philadelphia and your business and your office is literally been closed by the government, you can't produce.
Yeah, you have to be able to shut down. We have questions piling up, so I'm going to hit you with some of these. So first question, this is something that a lot of brokers are dealing with. Brokers, please submit your questions in the comments. But the first one I see here is broker just ordered an appraisal. They said they could do it for $775, not the listed $525 on the price sheet. Our AE at Plaza says the appraisers are upping their fee due to volume. How is that not price gouging and exploiting a national emergency? So basically, the normal price that is disclosed is $525. However, my understanding of the situation is it's not the appraisal management company that's necessarily raising their fee. It's the appraisers locally, and basically charging an extra $200.
Look, it may be. Again, this is a little bit outside my area of expertise. There's usually these are created statutorily, so there's usually something. There's not like a common law thing that says you can't exploit an emergency. That's created by a statute. There has to be a statute. Now, I know there are state statutes, and there may even be a federal statute. You'd have to look at the terms of those statutes to see if the price increase is beyond a point and or is somehow justified. So I think that's really what you have to look at. There's a statutory answer to that. Sorry to be such a lawyer about it, but without reading the statute, I can't tell you. It may very well be, but there might be a defense based on the way the statute.
So state by state, there's a statute that identifies essentially a percentage increase or an overall increase.
I believe there is a percent. I think it is based on a percentage, but there are also usually defenses to it. So you have to look at it state by state. Now, I am pretty sure that the bill coming through is going to have some provision from the federal government. And there may even be something constitutionally talks about national emergency once that's being declared. Again, this is a very specific point. So, I mean, there's an answer to it. I honestly don't know it because it's such a unique type of thing that we've never experienced. There may be something in the national emergency law and that would automatically authorize something that I'm not aware of that, but it might be.
Absolutely. So here's another question that's been coming up a lot recently is brokerages having different comp levels, lender paid compensation levels by lender. So hypothetically, one lender they're at 2%, one lender they're at 1 3/4%, and having this variable comp plan. As a broker, having that variable comp plan, is that a violation of steering? And that's one of the questions that I've obviously brought up to you before. Is if your LOs are have a variable comp, meaning they're getting a percentage of the revenue, that's clearly a steering issue. But if they're set at if a loan originator is getting paid the same amount, but the brokerage is considered an originating company, and you have varying comp with your lenders, is that steering?
As it is not steering as long as the loan officer is not set up on a percentage of that as compensation. So say it another way, you can have these varying comp levels and your LO gets paid the same regardless of which bucket or which lender he utilizes or she utilizes. In that case, because you have a consistent and constant comp to the loan officer and the loan officer has no incentive to steer because they get paid the same either way, then you would not have a steering problem. That is actually why we have that anti-steering disclosure. Again, you have to comply with that as well. So as long as you comply with the anti-steering disclosure and your LO is paid the same regardless of which lender is chosen, then you're okay. Now, if you have a scenario where the loan officer gets a percentage of what you as the broker receive, then you would have a steering problem because the loan officer's compensation would be affected by the choice of lender, if that makes sense.
Yep, no, that does make sense. What about as far as borrower paid compensation? This is a topic that comes up. If a loan officer is hypothetically paid the same, doing borrower paid compensation, is this permitted? Because I think one of the things that we get into a gray area with is, if you are the proxy that we talked about before, if you're changing from lender paid to borrower paid strictly for the reason to give the customer a better deal because they shopped around, that's actually not a justifiable proxy for going borrower paid. Is that accurate? Can you?
Yeah, for the most part, yes. Let me answer it this way, and this gets really confusing because they did kind of a bad job when they wrote this provision up in the law, because the first sentence basically says it's not a proxy to use borrower paid. Stop. If you just read that sentence, I would say it is not a proxy because that's pretty much what it says. So you go to borrower paid. But what they said then, they said borrower paid is not a term of a loan and you can pay differently based on borrower paid. Okay, stop. But then the next sentence says, nonetheless, borrower paid cannot become a proxy for loan terms. And that's where we get in a problem. So, because here's what happens. If you're going skinny, and in order to go skinny on a deal to beat whoever, right, then you go borrower paid. And every time you go borrower paid is when you're going skinny and vice versa. Then there's a correlation between borrower paid and terms. That correlation is what creates the proxy. Now, for example, if you went borrower paid for 50 million reasons why, and only one of the many was the rate, and there was no correlation, then it wouldn't be a proxy. But that's in a nice theoretical world. In the real world, we know what happens. So the bottom line for brokers is when you can use borrower paid, and no one's going to really love this answer, but the only way you can really use borrower paid legally to get skinny is if you take the hit. So in other words, let me give you an example. You're going to have a lender, the lender's going to pay you $275 and you pay your loan officer $150. You can't get the deal done at $275, right? So you got to lower the rate, and you decide to say, okay, well, we're going to lower the rate on this, and we're going to go borrower paid to make this work, right? And but I still going to pay my loan officer $150, but instead of receiving $275, I'm going to charge the borrower $200, and that's going to make this deal work now. So I, as the broker, take the hit. I go skinny. I only get my 50 basis points on top of the broker, on top of the loan officer. But that would be permissible and a permissible use of the borrower paid compensation, because the loan officer their comp is not changing.
Got it. So here's the follow-up question that came up on borrower paid is actually not borrower paid, on the previous question on the varying comp from lender to lender. If you're a broker owner and you're a single broker owner, and you have no LOs and you're the originator as well, and you have varying comp, in that case, that would be steering, because you're the loan originator and the broker owner, and you're going to you're picking a lender based on, you could be picking a lender based on who's paying the most.
This is getting really complicated now, and so follow me through this, because there's a whole provision in the law.
So basically, there's a lot of one-man shop broker owners. So like I start a company, it's Ari Karen LLC, and I'm Ari Karen, the loan originator. I don't have any employees. So I'm both the broker owner, the owner of the SLLC, and I'm also the LO.
Sure.
I have 5 lenders at varying comp levels, and I basically am the only loan officer. By definition, I'm steering, because if I'm the only one that can benefit from it.
Here's the way it would work. I'm going to give you a long explanation, because that's the only way to really accurately answer this. So bear with me for a second. All right. Number one, you got to remember, in the comp laws, they put in a provision that said compensation paid as an owner is, as long as it's paid in accordance with your ownership percentage, you can be paid profitability, right? So if I'm an owner and I get profit, I can obviously receive profitability from my enterprise, because I'm the owner and the rule says that, right? And again, it has to be in accordance with your ownership percentage.
So basically, you're saying as long as the owner as an LO has a comp agreement that has a set LO comp for them as an LO, then the excess to the company would be omitted from this calculation.
I think that's one thing. And yes, I think that's correct. And the other piece of it is that, there's a whole provision you have to go through in which you first have to determine the available lenders. I mean, and this is why it gets detailed. For example, you still have to go through and choose, provide them I call it the holy trinity, the 3 loan options, right? Lowest rate, lowest price, lowest combination. So you still have to go through that process, and that process is what is actually supposed to prevent steering, because the borrower is given those options. And if the borrower doesn't choose one of those options, or chooses, or does choose it, that's sort of what protects the borrower from steering. So it's that safe harbor you go through that protects the sole owner. But ultimately, you're probably right, Anthony, that there is to an extent, a provision of steering that could go on. I mean, that's a loophole in the rules, I think, if you really thought it through.
So our question for you is on, as we think about the couple of questions that came up while we were in California, is a broker had mentioned that they get paid by their company through an LLC that they own. So they're a loan originator license. Their license is under a brokerage. they're 100% owner of an LLC, and the company pays the LLC. Now, I believe we had a pretty defined answer here that this is kind of the definition of a RESPA violation.
It's not only a RESPA violation, it's an IRS violation. I mean, near and dear to my heart, probably in 2003, before the world got a little crazy, right? I had a client that actually went to prison for this. I didn't represent them in the criminal case, but they had approximately 50 branches they set up with this as LLCs. And what happened is, by doing this, they avoided employment taxes and allowed people to shelter money. And the IRS came in, the FBI, and basically went into their offices one day, and the guy went to jail, I think, for 6 months. I mean, he had a criminal lawyer. I don't do criminal, but essentially it was tax evasion. Because what they did is they said, they set up. So number one, I think there's a really big IRS risk of that. I wouldn't do it. Number two, you're right. It is absolutely a RESPA violation if you're paying somebody and again, sorry, go ahead.
No, I just want to make sure we clarify, because this has come up, is, if a loan originator says, hey, I own the LLC, they're paying my LLC that I own 100% of. But the problem is, this entity is not the entity that originated that loan. So it's impossible for the broker to compensate an entity that is not the originator. Even though this person owns it, that's still not the originator.
Yeah, I believe, and I may misquote the name of the case. You can get it. It's like a 2014 and 2015 opinion from enforcement action by the CFPB. I think, and I might get the name wrong, so forgive me if I do. I think it was Meridian Title, I think was the case. But it was 2014, 2015. And what they said is they were paying independent contractors, or they were paying people who were W-2s that the CFPB said were actually independent contractors. Even though they were W-2, they met the independent contractor test. And because they were not employees, which is a RESPA exception, it was a violation. So in that case, they weren't even set up as other companies. Other companies are kind of 2 steps worse than that, right? These were actually W-2s they said should have been other companies, and because of that, they hit them for a RESPA violation.
So whether it's an LLC or S Corp or C Corp, that doesn't matter. If you're the LO, compensation needs to come to you. We're not going to get into W-2 1099 today.
Right.
No matter what, whether it is hypothetically a W-2 or 1099, you need to receive that directly in your name. You're the loan originator on the application. If you received in the name of an entity, that's a RESPA violation. Just understand, when we talk about that, I think it's important, because this is a point that you brought up, because everybody thinks of compliance in context of, okay, I work for the company. If anything goes wrong, it's the company that's going to get hit. But all of these laws have been written where there's the company that faces a penalty, and the LO would also face a penalty as well in any of these LO comp violations or in RESPA violations, correct?
That is correct. And also understand something. A lot of people try to put substance over form here. Like, look, I understand it's a pass-through entity, right? But it's still a pass-through entity. It's sort of like, my analogy to really simplify it is, if you go 56 miles an hour, are you speeding? If the speed limit's 55, yes, you are. You may have a really, really good reason why you do it, but there are laws, and those laws have specifics, which sometimes you can use to your advantage, i.e. loopholes, right? And other times they work against you. These are specific rules with specific provisions, and there is a difference between an entity and a person. And as a result, now, I will say this, just so I know somebody out there is probably thinking it, okay? And I want to say this one huge caveat, because I don't think you should do it. I think
the problem in caveats is people go way like that. We can't even go.
Yeah, I know.
People get way.
I hear you. That's why I don't even want to do it. But
so let's just stick with
Okay. Keep it easy.
So another one I think is important right now is the topic of let me just make sure I read this correctly. Makes sense. Make an agreement between the LLC and yourself. So makes sense. Have to make an agreement between the LLC and yourself. Yeah. Just so we're clear, people. What we're saying is, you as an LO hang your license. You originate loans under a brokerage. You close loans. Your compensation has to be in your name directly. Whether we're not going to get a W-2 or 1099 today, but however you're compensated, it's got to be in your name. It can't go to an LLC and then you have a relationship with a sub entity. That's the RESPA violation. And again, that's where you can get in a lot of trouble. Both the loan originator and the company would face penalties there. And I realize that real estate agents, people throw out certain things related to other industries. we're mortgage professionals. We're licensed under the National Mortgage Licensing System. We're licensed under our state regulations that are specific to mortgage originators. So we're not real estate agents. Even though remember, is a separate entity, but as a loan originator, you're not allowed to receive LO comp under an entity.
Correct.
So another question came up here is, as far as here, where did it go? Can you go over the Equal Credit Opportunity Act rule on a file where the borrower withdraws for whatever reason? Do we need to send out a letter to them or just document the withdrawal and close out the file?
That's really fact dependent because it depends who's just making the decision on the loan. So many times that will be done by the lender, and I think that's something you have to deal with based on the lender and your and how you work with that lender. Many times that will be done by the lender because the lender is making the credit decisions, and so the draw would be from the lender. But that is not a universal decision. It's something you would want to work with your lender on and be on the same page. You don't want to both be sending out letters. That would be a problem, right? Because so usually that will be done by a lender.
So I think it's important that brokers understand that at the end of the day, so even though the lender's supposed to do that, are you getting the lender's Equal Credit Opportunity Act, is the withdrawal notice and putting in your file? Like, as a broker, what's your responsibility to make sure that's documented? Whether they send it or you send it, are you retaining that one way or another?
It's a little tricky because if you are sending the withdrawal, then obviously you need to retain it. Yes. If the lender is sending the withdrawal, then I think it would be a good idea to retain it if you could, but I don't know that you absolutely need to. I mean, what you're really talking about is who's going to be issuing the HMDA data on that, and that's generally going to be coming from the lender. But you want to be clear about that. And if you do have copies of it, it's better to keep it than not.
All right. We got about 8 minutes here, so I'm going to get a couple more questions in. One question that came in is, can you comment on how branch managers can be paid as a percentage of their P&L for a branch? So I guess that's a non-producing branch manager. They're permitted under LO comp or whatever compensation rules to be paid as a percentage of the revenue, or I guess paid off the profit and loss. So whatever the profit and loss is of their branch.
Yeah, let me handle this two ways. First, on a non-producing branch manager, yeah, they're not under LO comp. Just be careful what non-producing is, because there's a very clear definition that is not necessarily historically what people think of it as. It's non-producing is not, I don't close loans on my name. It is somebody who does not basically talk to borrowers about any potential loan scenarios. So let's say you're a non-producing manager. That would be somebody who maybe goes around, meets realtors, meets builders, doesn't deal with consumers. That's non-producing. I will tell you, for every time I have somebody say they're non-producing, I will Google their name. And true story. I mean, I'm on the phone with a non-producing manager. I Google their name, and I see them on the on the internet. Call me for your loans. I can get anything closed for you. Which obviously they're not producing. They're soliciting loans, talking to borrowers. So that's one thing. But yes, if they are truly and legitimately non-producing, which you got to be really careful of because it's a big violation, and it's easy to catch, then you're right. The rules go away. You could pay them on a straight P&L. So now there is a way to sorry to interrupt, Anthony. If you want me to go down to it, there's sort of a way you can get around that for producing managers. Do you want me to quickly speak to that?
Yeah, go ahead.
Okay. So for producing managers, it's not going to be an actual P&L, but take your old P&L, like good old days. Take out of it any loan level expenses, right? So concessions, appraisals, like those things, right? Take that out. So you can't hit them for costs for that. And then in terms of the profit, instead of paying actual profit, what you pay them is you back into a number that looks at the gross profit of their loans that they usually make on us over a period of time. So you average it and you say, look, over the average year, the gross profit on your loans is 275 basis points. I'm making it up, right? And then you subtract out those non-loan level expenses. So if the branch continues to act in accordance with what they've done historically, you would effectively be deriving what would amount to a P&L. So there's sort of a way to get around that. Is it perfect? No, you can't adjust it every month. So, you have to have some good data on it, but there's a way to sort of circumvent, I would say circumvent that, do it in compliance with the rules. If you're going to do it, call me on that stuff. It's a little more complicated.
Are you seeing, we'll wrap up with two more questions. You obviously, Strategic Compliance Partners is a national compliance service offering that Brokers Are Better has a partnership that we offer our members of AIME, and basically it, essentially is your compliance procedures, policies in a box, but it's constantly being updated with both state and federal policies changes. It's also being updated as their company is on the front lines dealing with audits of brokerages in different states. So they're literally adapting their policies and procedures and how they're guiding their clients based upon what they're seeing in actual audits and what they're asking for. Are you seeing any changes or anything really impactful from an examination standpoint that brokers should be concerned about or thinking about? And obviously there's 50 states out there, so I would probably say if it's one specific state or a one-off situation, we don't want to get into that, but anything broadly.
It's always changing, Anthony. I mean, and the trends are constantly changing from day to day. You're going to have trends coming out of this thing, the coronavirus. What will they be? I don't know exactly. You just have to be, that's one of the benefits of what we do, is because we've always got our thumb sort of on the pulse of all these regulators at federally and state levels, and we're constantly updating. I mean, in addition to the policies, we're sending out alerts, we're telling them things that are going on. We also have broker open packages that kind of explain to them all the things they have to do in their first year business, how to do call reports, all these types of things that they have to deal with, the documents they're supposed to retain, and the disclosures and things like that, as well as having sort of advice built in. So it's just an ever-changing thing that it changes every day. It really does.
Got it. And then as far as, I'm just going to go ahead and go with one last question. Can a company recoup comp from a loan officer from an EPO? So if a transaction closes, there's an early payoff on that transaction. When the brokerage pays back the EPO, can they go back to their loan originator and recoup the compensation that loan officer received on that transaction?
This is where employment law comes in as well. If you correctly drafted your employment agreement, the keyword being correctly, then yes, you could do it. If you didn't, you can't. So correctly, when an employee earns money as defined in the contract, or if the contract doesn't define earned, then they earned it. Under most states, as soon as the 1003 got signed, then you have to pay them. There's nothing you could do. It would be like saying to an employee who worked at a store, at a retail store, you got the change wrong for somebody, I'm going to take it out of your pay. You can't do that. So it would be exactly the same as that. Now, if you defined earned in the correct way, such that they hadn't earned the money until that EPO period had expired, and your practices were consistent with that, then you would be able to do it. So if you've set yourself up right, then yes. If you've set yourself up, or you haven't set yourself up right, then no.
Got it. All right. So here's what we're going to do. Guys, we are going to wrap up. Obviously, we got Ari here for a half hour. Ari's going to come back and do another Ask Ari in another couple of weeks. But we're hoping this was impactful and valuable. Their company, Strategic Compliance Partners, again, is something that you can reach out to partnerships@aimegroup.com and learn more information about. We think it's an extremely valuable service for the price of it. We truly believe the combination of what you get from a policy and procedures perspective and also a support perspective, it'll put you in a position where you're well informed. You don't have concerns about an auditor or examiner coming into your office and not being prepared. So we strongly recommend the service. And we hope everybody got a lot of value out of this interview. So Ari, thank you very, very much for taking the time out of your day to be with us today.
Oh, thank you for having me. I appreciate it.
Have a wonderful day, guys.
Thanks, guys. Everyone be safe.